In 2000, a country decided it was done playing by the rules. It's done pricing its most valuable export in US dollars. Done holding its savings in US Treasury bonds. Done depending on a currency controlled by a government thousands of miles away. So it made a bet it would leave the dollar system. Within 3 years, that country was invaded. Its leader was dragged from a hole in the ground. Its oil contracts were rewritten. And its monetary experiment was erased. Officially, none of this was about currency. Unofficially, that's where the story begins. This isn't a conspiracy story. It's a systems story, a power story, a math story. And it matters right now because more countries than ever are quietly asking the same question. What happens if we stop using the dollar? The country was Iraq. And what happened next wasn't just about war. It was about the architecture of the global financial system and the cost of stepping outside it. To understand why this matters, you have to understand what the dollar system actually is. It's not just a currency people use to buy things. It's the operating system of global trade. After World War II, the United States emerged with most of the world's gold, the largest economy, and the strongest military. At the Bretton Woods Conference in 1944, countries agreed to peg their currencies to the US dollar and the dollar to gold. That made the dollar the anchor. In 1971, President Nixon ended the gold link. The dollar was no longer backed by gold. It was backed by something else: trust, military power, and the scale of the US economy. But the real masterstroke came in the 1970s. The US struck a deal with Saudi Arabia. Oil, the most important commodity on earth, would be priced and traded in dollars. In return, the US would provide security guarantees. This created the petrodollar system. If you want oil, you need dollars. If you need dollars, you hold dollar reserves. If you hold dollar reserves, you buy US Treasury bonds. That means the US can run deficits, huge ones, and still find buyers for its debt. It's an elegant loop. Oil exporters accumulate dollars. They invest them back into US financial markets. That keeps us borrowing costs lower than they would otherwise be. It strengthens the dollar's dominance. And it gives the United States a powerful tool: financial sanctions. Because if global trade clears through dollars, and dollar transactions clear through US-linked banks, Washington has leverage. That's the system Iraq challenged in 2000. Saddam Hussein announced that Iraq would begin selling its oil under the United Nations Oil for Food program in euros instead of dollars. On paper, it seemed minor. Iraq's oil output was constrained by sanctions. The euro was new. The dollar was dominant. But symbolically, it mattered. If a major oil producer could successfully price oil in euros and benefit from it, others might follow. And timing mattered. In the early 2000s, the euro was strengthening. Between 2000 and 2002, it appreciated significantly against the dollar. Iraq's euro-denominated oil sales actually increased in value as the euro rose. In simple terms, Iraq made more money by not using the dollar. Now, is that alone enough to threaten the system? No. But systems are fragile not because of one large defection. They're fragile because of precedent. If Iran followed, if Venezuela followed, if Russia followed, demand for dollars could slowly erode. And here's the uncomfortable math. The United States runs persistent trade deficits. It imports more than it exports. Normally, that would weaken a country's currency. But global demand for dollars offsets that pressure. Foreign central banks hold trillions in dollar reserves. As of today, roughly 58% of global foreign exchange reserves are still held in dollars. That number used to be over 70% 2 decades ago. It's declining slowly. If demand for dollars falls significantly, 2 things happen. First, the dollar weakens. That makes imports more expensive for Americans. Inflation rises. Second, foreign buyers purchase fewer US Treasury bonds. To attract buyers, yields must rise. That increases borrowing costs for the US government. Higher borrowing costs mean higher interest payments. The US already spends over $1 trillion annually on interest. If rates rise structurally, that number compounds. That's not ideology. That's arithmetic. So when Iraq shifted to euros, it wasn't just changing invoice currency. It was signaling that oil, The backbone of global energy trade didn't have to be dollar-based. Then came 2003. The invasion was publicly justified on weapons of mass destruction and security concerns. The euro issue was barely mentioned in mainstream discourse. After the invasion, Iraq's oil sales reverted to dollars. Correlation is not causation, but incentives matter. Even if currency wasn't the primary driver, the restoration of dollar-denominated oil fit neatly back into the existing system, and Iraq was not the last to test it. Years later, Libya's Muammar Gaddafi proposed a gold-backed African dinar to trade oil independently of the dollar and euro. In 2011, NATO intervened. The regime fell. The currency idea disappeared with it. Again, multiple causes: political repression, civil unrest, geopolitics. But notice the pattern. Attempts to rewire the monetary plumbing rarely unfold in isolation. Now fast forward to today. Russia sells oil and gas in rubles and yuan. China has launched oil futures contracts priced in yuan. Countries under US sanctions explore alternative payment systems to bypass dollar clearing. The rhetoric is loud: de-dollarization. But the reality is slower and more complex. Here's why. The dollar system persists not because it's morally superior, but because it's convenient. The US Treasury market is the deepest, most liquid bond market in the world. Daily trading volume in treasuries is measured in the hundreds of billions. You can move massive sums with minimal slippage. If you're a central bank managing hundreds of billions in reserves, liquidity matters more than symbolism. China's bond market is growing, but capital controls remain. The Eurozone lacks a single unified fiscal authority equivalent to the US Treasury. The yuan is not fully convertible, so even countries that resent dollar dominance still hold dollars. It's a prisoner's dilemma. Individually, diversifying away from the dollar reduces dependence. Collectively, a rapid shift could destabilize global markets, including their own. And here's the irony. The more the United States uses financial sanctions, the stronger the incentive for others to build alternatives. In the short term, sanctions demonstrate power. In the long term, they encourage exit planning. We are now in a slow-motion experiment. Central banks are gradually increasing gold reserves. Bilateral trade agreements are denominated in local currencies. Digital payment networks are being built outside traditional Western systems. But the dollar remains dominant, because systems don't collapse overnight, they erode. Erosion is hard to spot in real time. Back to Iraq. Did leaving the dollar system cause the invasion? No serious analyst would reduce a complex war to a single monetary decision. But did it intersect with a broader architecture of power? Absolutely. Currency is leverage. Debt is leverage. Energy pricing is leverage, and leverage invites resistance. The uncomfortable truth is this: the dollar system benefits the United States enormously. It allows structural deficits without immediate currency collapse. It lowers borrowing costs. It extends financial reach. Other countries know this. Some accept it as the price of stability. Some resent it quietly. Some try to exit. What happened to Iraq was not a simple morality tale. It was a demonstration of how deeply intertwined finance and power have become. Today, the question isn't whether one country can leave the dollar system. It's whether many can coordinate to build a credible alternative that requires trust, scale, liquidity, military backing, legal infrastructure, transparent markets. You don't replace a global reserve currency with a press release. You replace it with decades of credibility. And so we're left with an unresolved tension. The incentives to diversify away from the dollar are increasing. The structural advantages of the dollar remain enormous. Somewhere between those two forces lies the future of the global monetary order. Iraq tested the edge of that system and paid a catastrophic price for many reasons, not just one. The larger question now is quieter, slower, more systemic. If enough countries decide they no longer want to finance American deficits with their reserves, what happens then? This time, would the consequences look the same or very different?